Hello, chart watchers, and welcome to this Friday, December 22nd Market Watchers Live show with Aaron Swinlin and Tom Bowley. I'm your host, Tom Bowley. Today's show is being recorded, so you should be able to play back any or all of Market Watchers Live at your leisure. If you're unable to attend the show live, you can now go to www.stockcharts.com/webinars. Follow the link to Market Watchers Live and play back the show. Each show will be archived on our site until the next show begins, so you'll have roughly 24 hours or so to review it. If you'd like to review an older show, you can now find those at our YouTube channel or on Facebook. During today's show, please feel free to submit ticker symbol requests, questions, and comments using the chat window next to the video player. Later in today's show, we'll select stock symbols from your requests, and we'll use those in the 10 in 10 segment at 12:50 Eastern Standard Time, where I'll attempt to annotate 10 stocks in 10 minutes. Market Watchers Live now airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. If you'd like to be part of the show, you can reach us via our chat room or Twitter. Our Twitter handle is at Market Watchers Live. That's at MKT Watchers Live. As you leave today's show, we'd love to get your feedback. In the lower right portion of your screen, you'll see a How'd We Do section with a link to a very brief one-question survey. Let us know what you think of Market Watchers Live, and feel free to provide us some suggestions for improving the show. For those of you joining us for the first time today, welcome to the show. It's going to be a good one, a year-end review, and we're certainly glad that you are with us. And for our regulars, welcome back. Just a couple of very quick announcements before we get started. We're going to have a really good show today. There will be no Market Watchers Live shows next week. Of course, we have the Christmas holiday on Monday and the New Year's holiday the following Monday, and the stock market is closed on both of those days. And next week, between the holidays, Tuesday through Friday, we will be running a best of Market Watchers Live, which will include many of our interviews that we've had in the past with special guests, and will also include educational segments that we've done in the past. Should still be great refresher for everyone. Our next live show will be back on Tuesday, January 2nd, 2018. And with that, I'll bring in my co-host, Aaron. Like we said, we've been talking about, it's kind of hard to believe, going into the holidays and getting ready to end another year. How are you doing? You ready for Christmas?
I actually am pretty close. I'm to the present wrapping stage and the baking stage. So okay. I'm doing pretty good at this point.
Yeah, those are two stages I'm not a fan of.
Yeah, they're never that fun. I used to love baking, but now that my kids, grown up, it's become more of a chore. So
did you say baking or bacon? Because I'm not
baking.
Okay, just clarifying. I know we got a big schedule on tap, lots to get through. We're going to do a big year-end review, and we'll be talking about just a little bit. But you can go ahead and go through the agenda with everybody and give us that first market update.
I shall, and it is Friday's agenda, despite it saying Thursday. We will be doing a year-end stock review right there at the top of the program after our technical headlines. 10 and 10 to 1 will follow, and our first one is going to be Square, SQ. So if you want to go take a look at that chart and take a few notes, you'll be able to figure out what will work best and what matches with Tom or not. And then I have a sentiment review, so we'll go through that at the end of the program. And finally, we'll finish up with mailbag and wrap up. So with that, I think we should get right started with our first market update. All right. So here we go. I've got our candle glance set up so that we can see what all the markets are doing right now. There was a lot of talk, I think, at the beginning of the market day about the new, I know with the government shutdown is apparently not going to happen, but it didn't seem to affect stocks much. They're all heading down in declining trends that actually are continuing from yesterday afternoon. We can see that the Nasdaq opened lower, and it is forming what looks like a symmetrical triangle. So unfortunately, that would probably mean more downside. Russell 2000, pretty much a textbook reverse flag. So I would expect, after seeing this consolidation, probably going to see lower prices there, but we'll see. Right now, it's the TSX is really traveling here mostly unchanged, but has been in the red most of the day. You can see that treasury yields are slowly rising right now, but still lower than yesterday, reading now at 24.88. We can see that UUP had a nice gap up, but it's pulling back from its intraday highs right now. Commodities are up, and we can see that USO is not quite up. Right now, what we're getting is a almost unchanged, but it was a difficult morning for USO with a gap down. And now you can see gold is pretty much on its nice streak rally, continuing the rally that started again yesterday afternoon. We'll have to see. It looks like it's forming a bull flag. So, gold is starting to really shine right now, and the dollar is looking very weak. So I would expect to see a lot of movement to the upside for GLD. The VIX, we had low numbers, and then all of a sudden, boom, we're reading just under 10 for the VIX, which is still not really what I would consider, bearish feeling amongst investors. Anytime you're below even 12, I would say there's complacency out there. Declines are leading advances right now, not a surprise given what we're seeing there. Let's look at our market summary and get a feel for what the sectors are doing right now. And currently, we can see that energy is having the best day, up over 0.5%. Healthcare and financials are the laggards today, both of them down 0.5% right now. Natural gas, gold, oil, services are the top winners right now as far as U.S. industries are concerned. And our laggards right now are banks, semis, disk drives. So we're seeing a lot of technology and finance in the bottom. And as far as our international ETFs, Russia's having a particularly good day. The Russia ETF is up over 1.25%. And our laggard right now is Spain, down almost 1%. And with that, I'm going to pass it back to you, Tom, for some more technical headlines.
All right. Appreciate that. Yeah, it's kind of an interesting day, seeing mostly down action throughout most of the major indices. I do want to mention some of the economic reports that came out this morning, because we really had a pickup in economic report activity here the last couple of days. This morning, we got November durable goods out. They rose 1.3%. Sounds good on the surface, but the market was expecting 2%. So actually a little disappointment. And then if we strip out the transports out of the November durable goods report, they actually fell 0.1%. The market was looking for a rise of 0.5%. So again, not the best of news there. November personal income rose 0.3%. Market was looking for 0.4%. Another disappointment. However, November personal spending came in a little above expectations. It rose 0.6%. The market was looking for a rise of just 0.5%. Finally, and this has been a streak all week, anybody looking at home construction, pretty happy with the reports that have been out all week. We kept that winning streak alive this morning at 10 a.m. The November new home sales report came out, 733,000 units. The market was only expecting 650,000, so a huge beat on new home sales. And again, that continued a streak of better than expected reports all week out of that home construction space. And then finally, December consumer sentiment finished at 95.9, or came in at 95.9. The market was looking for 97. So a little bit of disappointment there. But that new home sales report was pretty interesting. The reaction in the bond market's been pretty muted the last 2 days, even with all the huge, the number of economic reports that we've had. Several misses, a couple look really good. And the bond market just kind of yawning after the big move it's had. It's really consolidated here in a pretty narrow range the last couple of days. I find this to be somewhat bullish for the yield, just because it did break out above the prior highs. And rather than completely falling back down and falling apart, we're kind of holding that breakout level. So we'll see. Maybe one thing to watch would be an island reversal next week here. You can see that that's exactly what we saw at the last high back in October, where we had gapped up on the yield, went sideways for a couple more days, and then gapped down, left that yield up on an island for 3 days. Something similar could happen here. So we want to at least keep an eye out for that. But the trend in yields clearly is to the upside. We don't hit a major resistance level until we get back to that March high around 261 or so.
Hey, Tom, we're seeing my screen. I think you might want to show yours.
I thought I switched over.
Yeah.
Oh, it says I can't. I thought I switched, but it says I can't share.
So it should work now.
All right, let's check it out. It says no. Okay, here we go. Now it's letting me. Oops, sorry about that. I thought I had it the whole time.
Yeah.
But fortunately, I was reading mostly the economic report, so I don't think it was any big deal. The only chart I had up here was the 10-year Treasury yield. But you can see this move up. What I was talking about, the key to take away is maybe we could potentially see an island cluster reversal. And those occur off of an uptrend or a downtrend if it's a bottom. But off of an uptrend, you can see that we gap up, trade sideways here for a couple of days, and there's really no set number of days. It's just sideways action after a gap up and then a gap down to complete that island up here. That's what we saw in October. It's not a long-term reversal. These are just short-term reversal patterns, but you can see that after we gap down and left that yield up on an island, we did move down for the next several days. And so these types of signs can be very important if you're trading interest-sensitive stocks like financials, some of the REITs, utilities, that sort of thing. But here you can see the three candles after the gap up going sideways. We may simply just keep moving higher. But again, if it's a reversal like we saw in October, we actually had a little one here back in November as well, where we gapped up, went sideways for 3 days, gapped back down, and you can see that the yield struggled for the next week and a half or so. So that's something to keep an eye on. But overall, this week, I think most of the reports were pretty strong, especially in the housing area. One of the huge crazes that we've had all year, but especially here recently, Aaron, has been on the cryptocurrencies and many of these blockchain stocks and so forth. And I think the insanity, I'm not going to, well, maybe it's not the insanity. It seems insane at times when you have a company that yesterday was a beverage company and has announced that now it's going to become a blockchain company. This is Long Island Iced Tea Corp. And I want you to take a look at a little bit of a movement, maybe some anticipation of the news, who knows. But a huge gap up with that announcement just by saying that they're going to become a blockchain company. This stock ran from $2.50 up to $9.50 yesterday at the high. Currently today it's trading at $5.76. So you can see the volatility in this stock. And this isn't the only one. There are a ton. Aaron and I were talking about some of these right before the show started, but take a look at UBIA. This is UBI Blockchain Internet. Stock ran from $5 to $115 in about 9 trading sessions. And if you think that these stocks don't pull back, and Aaron, you were talking about parabolic rises.
Exactly.
This is definitely a parabolic move to the upside, and you can see the move back down. I want you to go back to late February and early March and take a look at what this stock did, rising from the low single digits up to about $30. And then 3 weeks later, it was back to the low single digits. So these many times when they go up, they do kind of come right back down to where they start. And so just wanted to point this out. I mean, this is so beyond what I can handle from a risk perspective. I couldn't consider trading this. I mean, literally, I could lose on one of these trades and it could wipe out my last 20 winning trades. So I would just be really careful with this group.
And all of these charts you're showing, I mean, these are textbook parabolic moves. You know, you get that straight up, and then when they go down, it's a price shock, and it usually goes all the way down to the original basing pattern. So, for example, with this one, I mean, I don't think it's over. I think it can go down to that $10, $15 level for sure.
Yeah, I don't know if it's over or not, but somebody else can test the waters. I'm staying the heck.
Yeah, exactly.
Yeah, I agree with you. I think these are, the risk is just incredible. And when they do move up like that so fast, it seems like the best thing since sliced bread. Usually it's not. Usually you're getting that last piece of the loaf, the heel.
Right.
So anyway, hey, I like the heel, by the way. But yeah, getting back to stocks here, a couple of other comments on today's action. The utilities were leading earlier to the upside. They've pulled back some from their high, but look at the beating that utilities have taken. And then this is a little bit of a lesson on support. We lost the 50-day moving average. We lost this breakout level right here, which was up at about $55 or so. The volume has picked up, and look how quickly we went down to the next support level, which is at 52. That's why, and I know we're looking at an ETF, but even with individual stocks, when support is lost, you really want to be careful. Okay, two more quick stocks to mention that reported earnings yesterday, and I bring this up because we talked about them yesterday on the show. Talked about how they were looking like a great report was imminent. First one, but a lot of it was built in. Remember, CTAS, Cintas Corp. They came out, beat on their top line, beat on their bottom line, gapped up, and look at the results since then. It has taken out about a month's worth of gains. And this is why I don't like to hold into earnings. They beat top line, beat bottom line, and yet we're still getting this huge move down. Bearish engulfing candle, negative divergence. Technically, it obviously is in trouble for now. I actually think if it, settles down at some point, it might be a great trade, but not now. And the other one is Nike, NKE. And on Nike, you can see the huge move up. Talked about this probably means great earnings. Well, their revenues came in at 8.55 billion. The market was looking for 8.39, so a beat on the revenues. And their earnings per share 46 cents. Market was looking for 39. So, but did it matter? Nope. We had a gap down. So buy on rumor, sell on the news. And I still like Nike. I think the breakout here around $60 is probably going to hold. We did get down to 60.13 earlier this morning and have reversed off of it. I suspect Nike goes higher, but I think this is just a lesson sometimes what happens after you've had a big move into an earnings report. So with that, we're going to switch over to one of the key topics of today, which is our year-end review. And with that, I want to just start off by just showing you quickly here at Stock Charts how you can go back and take a look at what has happened over the last year very quickly from the sector and industry group review. So here's your sector review. When you pull it up, you're going to see an intraday period. Well, you can switch this. Let's pull it up for a year. And this, you can quickly see what has led this advance during 2017. Technology on top. Might surprise you, but materials have been second. Then you got industrials, healthcare, consumer discretionary, all of these above 20%, even financials, 20.87%. And then we've been lagging in consumer staples and utilities, two defensive groups, and energy, which is now really piped up and is looking pretty good. Unfortunately, was struggled so much during the first half of the year that it hasn't quite been enough strength of late to take it back into positive territory. But that's just a quick summary, and then you can go into the complete industry summary down here at the bottom, and this will give you the intraday. But again, you can drop down to the 1 year, and you can see, okay, within consumer discretionary, what's been leading? Home construction up 74% this year. So a lot of these great reports that we've been seeing, prices have been built in throughout the year. We've been seeing the market expecting this kind of news. You can go down the list here. A couple of others that I would point out. One was the renewable energy. And I know back in January when I did the current outlook, stock outlook webinar with Greg Schnell, this was one of the areas that I actually said I thought could have a very good year. It had been down for probably 2.5 years, and money rotates in a bull market. And this one, obviously, money rotated, started to break out, started to make higher highs, higher lows, and this has been a great area in 2017. So I think with that, we can go ahead and switch over into some of our highlights of 2017. I know, Aaron, you've got a bunch of charts that you'd like to share with everyone.
Yeah, I thought I would do the major markets and indexes and probably the big 4 or 5 time, but I know you have a lot you want to go through as far as highlights as well. So let me grab this. So I'm going to start with the Dow, and I'm going to go through these pretty quickly because I just wanted to give you a feel for everything that's been going on and really point out some of the indicators and how they were very helpful over the year. I think. So, of course, we know that after the election, bull market rules became essential because you expecting bearish expectations or having bearish expectations was just not going to work for you this past year. I mean, it's been such a great rally, but what I've noticed that, of course, always worries me is this steepness that we've seen at the end of this year. And, it's not parabolic by any stretch of the imagination, but when we start seeing steeper and steeper rising bottoms, I always get a little bit worried. The PMO is starting to top. And what happens typically? Look at end of October when our PMO topped in this area. Consolidation. we're not seeing over the year, when we get these downside crossovers on the PMO, we're not seeing real declines. We get pullbacks and consolidation. The 50-day EMA was the bottom of price. That's where we were testing, and now since September, it's the 20-day EMA that is now holding as support. So it's just getting more and more steep. But I do worry when I see these tops. But it's hard to get overly worried when you see these overbought PMO sell signals. I mean, what would you expect to happen at that point? We should have seen a pullback or correction, but instead we're getting the sideways movement. So I just wanted to point that out really quickly. And I do have all these bull flags marked on a lot of these charts. So I do think we're going to head higher. I think right now we're just in that consolidation before the rise back up. But January could be certainly an interesting month. Here's what I'm talking about. We had a really nice rising trend channel that built up in 2016. And now, we broke out of that in September, remember, October timeframe. And now it's just getting steeper. So really on the weekly chart, I think you could make a case for a little bit of a parabolic move here. We are definitely overdue for a pullback at a minimum. But a correction, of course, under regular market rules, we would expect. But at this point, I don't see that. We just continue to have consolidating moves. I think the Dow is a good example. I wanted to show quickly the Nasdaq. I won't go through some of the other indexes because they're all looking about the same. But I think the Dow versus the Nasdaq 100 is really a good picture as to what's been going on. So back here, I was looking for, this looked like a Head and Shoulders building on technology. And of course, after that long decline, it didn't seem all that, the picture didn't look all that good. But instead, we had a nice rally. We formed a flag. I don't like these topping PMOs. I'll be honest. But they're really a function of the consolidation and the pullback. You're going to see some of those. What's really the concern, I would say, at this point when you're looking at a chart like this is you're looking at those PMO crossovers. They're pretty accurate. There's the upside crossover came in here after this little area of consolidation, which is what the previous tops had called for. So it's been an interesting year for sure for technology, but it did manage to avoid that pattern. And now we're looking at flags. So I can't get overly bearish, even though I'm seeing some topping PMOs. I think that's just a function of, regular momentum and what you're going to see. Let's look quickly at the mid caps. And, I've been watching this double bottom. I guess if you want to use that long tail, it could be a triple, but, it's coming off a rally. So really what we're looking at here is more consolidation. Double bottoms are continuation patterns, are not continuation patterns, they're reversal patterns. So what we really were looking at here was a double top, and it didn't execute, and it's instead formed another flag. So I think mid caps, while they haven't had that sort of parabolic look to them, and you can see that in the weekly chart, doesn't look quite as hairy as the others. So it's still in a pretty nice rising trend channel. And really it has more room to move up to test that rising trend channel at this point. IJR, which is the S&P 600. Here we can see at this point we had quite a negative divergence going on here, and we got that decline. So I'd say that divergence is done, but it's still held up on this support. Small caps, even though they got hit hard, it was like technology, and they're now trying to come back. And look at this nice flag that's now forming here. But over the course of the year, unlike, and I'm going to pull up the weekly chart, unlike the Dow and the Nasdaq, it spent most of 2017 consolidating. Granted, it was in a 65 to 70 range. The fact that we saw that for so long when we were watching all those other markets make their move up, I know that was a concern of mine, but eventually the bull market wins over. And we got that buy signal on the PMO. You can see right here in the thumbnail. It came in right about here. And so right after this breakout, of course, we got that buy signal. But look at the PMO is already turning up well back here. And it really was a good predictor for 2017 as far as the sell signal and buy signals. But I thought that was interesting that we didn't get this sort of parabolic look on the 600. And let's look one more. I want to look at the short-term indicators here. And again, I wanted to sort of review the year and what they did. And I think it's helpful because now going forward, you'll have a better idea of what we're looking at. And again, what I found this year, and I'm sure all of you did, is that, again, it was consolidation on these tops. And typically, when you get these tops, you should expect for them to decompress and unwind, that you're going to have a decline. But instead, we were getting, sideways movement. And in this case, this top didn't really turn into much because we had a rally to begin that whole the decline here on these indicators. And here's another case: top, consolidation, top, consolidation, top, consolidation. So, I mean, I think the indicators were pretty accurate. And if I moved these over and marked bottoms, you'd see that they were pretty accurate that way too. But the main one I wanted to point out were these tops, because again, bull market rules expect bullish outcomes, but I don't think any of us would normally expect to see these really overbought readings followed by a small rally. I mean, I think it was just, it's really, I think the thing to take away mostly from this year is, what can happen when the market, everybody, traders start to get really, really bullish. Economy starts to fire up a little bit there. And all of a sudden, you don't see any corrections. They're gone. That's pretty much what we saw this year. We never got anything like we saw in 2015. 2016, we even had a couple of little difficult declines, but we were already heading into this amazing rally. And in this case, I wanted to show you the bottoms on the intermediate term indicators for the past 2 years and how accurate they are. I would say that was a little bit of a beating we took there because we got those really oversold readings. We got the positive crossover, but had to endure a great amount of downside. I remember being very frustrated during that decline. So, but when we got the next bottom on it, that marked that rally. But notice on these others, they came in, we still got a nice little rally out of them before the following top. So I think it's interesting really to note, like I said, as far as this last year, bear market rules were never in effect. And the bull market rules were very, very, it was just a matter of you couldn't go wrong here. There were no bear market rules. We never had a decline. We really didn't. So here's gold, and looking at its year, it's been mostly consolidating. We got a nice move. This was an interesting double top that never actually executed. So now we're looking at it as I was expecting. We got that breakout out. I would expect to move to 1,300 easily, especially if the dollar continues to look terrible. But if you look at the weekly chart for gold, overall 2017, we did see a market rally, a rally. Of course, a lot of volatility in there, but overall, it's managed to stay, even in this decline, above this declining tops trend line, which is very, very long term. We got that sell signal on the weekly chart, so it did give us some warning here, and there's another one back in 2016. And let's see, what are we doing on time? I think that's about it. I would say that really, when you looked at USO for the year, it's just been a volatile ride, but a longer term V bottom here. And that looks like a pretty close head and shoulders, reverse head and shoulders to come off of that. So that was all good. And TLT, yeah, this was an ugly. Again, we've got a lot of volatility like we did with gold as far as moves, but the rising wedge executed. We're seeing prices try and return, but with indicators looking this poor on TLT, It's just been so volatile here with TLT, and I don't think that it's going to get any better in the coming year. And I didn't see the daily chart for the dollar because I've been getting all kinds of sell and neutral signals here, and it is pretty. Talk about textbook. I mean, this is a textbook head and shoulders, and the PMO flattened and is now heading lower. So, it's been a rough year for the dollar, and it tried to make it better, but I don't think it's going to get better from here on out. So that's what I wanted to show as far as highlights. I'll pass it back to you, Tom, because I know you have some as well.
Yeah, I want to go take a little bit different approach. First, I just wanted to mention that here is the S&P 500, which over the 5-year weekly chart, and we continue to move higher. It was a great year in 2017. Notice the ratio, the XLY versus the XLP, has continued and followed suit with the S&P 500. This is kind of one of the beneath the surface signals that I always watch to monitor the health and sustainability of a bull market advance. As the S&P has been rising, so too has the amount of money that has been shifting toward the XLY versus the XLP, and that's what makes this ratio go higher. Now, one concern I had for a while was that transports. Actually, I've got this versus the S&P 500. I actually should have this versus utilities. I think it actually will show much better because utilities have been struggling. So let's update this real quick. Yeah, you can see the breakout here recently above this relative downtrend that transports had been in relative to the utilities. Now we've got this picking up as well. If the economy truly is going to strengthen down the road, we should see higher interest rates. We should see transports doing well. And those higher interest rates tend to impact utilities in a negative fashion. So this ratio should go higher to support the S&P 500, as should the XLY, XLP, and they all seem to be aligned well going into 2018. So I'm pretty bullish at this point going into the end of the year. Yes, we're overbought, and surely we can get a pullback at any point, but this is one chart that keeps me pretty bullish. Now, I want to go through some individual areas of the market. So let me see if I can find where I put my chart, and here it is. I got some charts. I didn't annotate them, but I put them in a list so we can go through really quickly. Home builders, these are all of the best performing sector or industry groups that I'm going to go through these charts very quickly because I do think you can learn from the past. And so what I wanted to look at was maybe what triggered these groups in 2017. You can see with the home construction group, we actually had sideways consolidated for quite a while before breaking out in March above this prior high. And that has led to a lot of buying. Now, it has been somewhat parabolic. I'd be really careful with the weekly MACD that's stretched. A lot of times what leads you one year won't lead you in the next. But at least for 2017, you can see this has been a great area. Moving on, hotels also had a downtrend in play throughout 2015 and into 2016. We actually broke that in the latter part of 2016. I will caution you, though, if you're looking at these index charts, you'll see volume all of a sudden really pick up the beginning of December. Back at that point, Arthur Hill wrote a great article talking about how they changed the way that they were calculating volumes. So this does not mean all of a sudden everybody was getting into hotels relative to what the volumes were. You really can't compare these volumes. So be careful when you're looking at indices that you don't go back before December 2016. But here we got a breakout, a clear technical breakout at the beginning of 2017. And really, we haven't fallen below that rising 20-week moving average. So it's just a simple case of breaking out and trending higher, which is exactly what we look for in technical analysis. The broadline retailers also had kind of gone sideways, and then in 2016 we rose. But notice it pulled back in the fourth quarter, and we allowed the MACD to get back close to the center line. And then when we finally made a breakout here, you can see we were breaking out with the MACD, the weekly MACD, much closer to the center line, which I think allowed it to continue to push to the upside. The toys, very similar. Look at the highs in the late summer of 2016. MACD started rolling over. We went down right at the end of 2016. We got a centerline test on the MACD, and we got a 50-week moving average test right before we started with some solid movement to the upside here. This is the computer hardware group. So this is home to Apple. very important trend line that was broken back in August of 2016. We continued to trade very bullishly, bouncing off that rising 20-week moving average as we went into 2017, and the group has simply just continued it. But again, we're getting very stretched. We do have a negative divergence on the weekly chart here. The internet index, this thing has just been on fire. But similar to computer hardware, you can see negative divergence on the weekly chart. I'm not saying it's going to pull back. We may just see simple consolidation, but I do think internet stocks are going to have problems repeating what it did in 2017. The aerospace index, well, check this out. Sideways consolidation. We broke out to begin 2017. We haven't even had a 20-week test. I mean, the aerospace has been absolutely on fire. Now, this is a relative ratio, because if you're looking at the aerospace chart and you see the breakout sideways consolidation here, well, we didn't break out until the latter part of 2016. But if we look at this relative chart, actually right about that time, we broke this relative downtrend, maybe even in October before we started that big run. So it's important, too, to see how your group is performing relative to the S&P 500. I don't see any slowdown now, although this rally does look a little long in the tooth. The commercial vehicles and trucks, downtrend, pretty big downtrend into 2016. We finally broke. Look at the rising 20-week moving average continuing to hold, but we, again, are very stretched in this area of the market. Just a few more quick charts. The renewable energy group, this was one that actually, this was the downtrend that I had talked about. So going into 2017, of course, everyone wants to buy what's been hot. I think sometimes it's better to watch for some of the things that have not been hot and are starting to heat up. And you can see back in about May of this year is when we really started to make a big move in the renewable energy space, and they've been hot the balance of the year and may have room to run. We'll see. The distillers and vintners, here's a pullback again, last several months of 2016. And then in 2017, we regained our strength. Beautiful move to the upside in the distillers and vintners. Last two, specialty finance, sideways consolidation mostly for a couple years. Finally, beginning of the year, we make the breakout. Of course, this group's in the financial space benefiting from the higher yields as well. And this continues to go, although it is very stretched. And the final one I have is the mortgage finance group, which had been downtrending for 3 years and broke out in 2017. And you can see what happens when you get a breakout. It continues to strengthen. So with that, these are basically designed to take a look back at the end of 2016 to try to see what we could be looking at going into 2018. So with that, I know we want to take a look at maybe some of the 2018 expectations, and I'm going to turn it back over to Erin.
Okay. I was going to, honestly, I'm just going to talk real quickly about the Dow. I had to turn in for our timer digest my forecast for the Dow for 2018. So I wanted to show you the Dow a little bit here. So hold on. So I'm going to go back to my Dow weekly chart to talk about that. So my forecasts at this point, and I don't have them written on here, but we had to determine where we felt the Dow would finish after the first quarter, second quarter, and then finish at the end of the year. So I looked at this because, of course, that's what I need to look at. And as far as the weekly chart is concerned, it's looking good. I don't like this overbought PMO though. So my thought, I still think we're going to continue higher. End of first quarter, I'm looking for 25.5 for the Dow. And I think that's going to be pretty good after a month. I think we might come very close to that. But one of the things I did was looking at the monthly chart. This is where I came up with my quote unquote call, my forecast for the Dow. And again, I hate using forecast. I think I even talked to Tom earlier. I'm like, I hate using that word. It should be expectations, but this truly was a forecast. So I have to do that. So in any case, we're on a long-term PMO buy signal for the Dow. There's no reason. It's not even that overbought. We've seen it get more overbought. There's no reason for me to think that we're going to end the year, in a bear market. I think that we're still going to see moves to we first quarter 25.5, and then I'm looking for at the end of the second quarter, I'm looking for 26.8 for the Dow. So my thought is between the first and second quarter, we're going to start seeing more from the economy, see what's happening with the tax plan, how that's going to affect things, rising interest rates. There's a lot going on here, but I think ultimately we're still going to move higher. And my final forecast for the end of the year for the Dow is 28.9. So next year is going to be another bull market. We might have some stutter steps in between before we get there. But that's really my expectation for next year. So that's really all I wanted to share as far as the 2018 expectations. Because like I said, it's published out there now what those forecast numbers are. So I figured I'd share those and give you an idea of what I'm thinking. But really, it's all about the monthly chart and this PMO buy signal. And the fact that if you look in the thumbnail, even we're not decelerating whatsoever. And while we are, if you want to call it near term, for a monthly chart, I'd say it's near term. We are moving above those near term overbought readings. But as I said, we've seen it much higher. And I suspect we will see it go much higher. There's a lot going on as far as the economy next year. As I was saying, we've got, the yields and interest rates rising. We have to deal with, the tax plan. How is that really going to affect everybody? We're really not sure. Is the economy going to continue to grow? I think so. I think we're expanding, and with the new tax plan, I think it's hard to argue that we wouldn't have an expanding economy. So that's really my forecast. Okay. But you go ahead. What are your expectations anywhere, everywhere?
Well, as far as numbers and the indices, I probably would just try to avoid that. It's hard for me to look out a year. I try to look out, based on what the indicators are telling me now. I mean, I agree with you. I think we're looking at a bull market in 2018. I think that, things can change. I mean, obviously the market, one of the things I'll be looking for potentially for a reversal is the market continuing to move up and we start to see defensive areas of the market lead. So in other words, that XLY, XLP chart that I showed earlier, if the S&P keeps going up and we see a big turn down in that ratio, that will tell us that money is moving toward consumer staples. I'd be really careful about, if that were to happen. I think just the defensive sectors in general, a bull market is made up of wide participation. So we want to see all the groups or as many groups as possible moving higher. And we certainly have seen that in 2017. But I would begin to worry if all of a sudden the S&P was going higher for a month or two and some of the key sectors like technology and industrials and financials and consumer discretionary, start to tumble. All of a sudden the retail group, which is picked up, loses its luster and starts to move lower. Some of those things would begin to bother me. So I could sit here at the end of December and say, I'm very bullish about 2018, but I could then, come around March or April sometime, I could be looking at things and be completely different. So that's why I try not to make year-long forecasts, because I can change on a dime. Well, maybe not on a dime, but as these things start to roll over, you do start to grow a little bit more cautious.
If I didn't have to give actual numbers, I wouldn't.
Yeah. Well, bear markets, don't start in a day. There's a process that we go through in a topping fashion. So it, could take several months. I mean, if you go back into 2007, there were actually warning signs. Many warning signs began in 2006. And by the time October 2007 hit, the warning signs were flashing. But anyhow, I'm going into this looking at charts based on the fact that I'm believing that we are in a bull market, and I'm going to be looking for bull market rotation. So where I started at was looking on the last 3 months, those same charts, those sector charts, sector summary and industry group summary that I showed earlier in the show. I looked at that, but rather than look at the last year, I looked at the last 3 months. And what I did is I just said, okay, everything's been flying the last 3 months. So I wanted to narrow it down to the industry groups that are toward the bottom in terms of relative performance the last 3 months. And from those, I went back and looked at weekly charts. So that's where the DJ USBC that you're looking at, broadcasting and entertainment, that's where it came from. So what I'm trying to do is say, okay, I don't want to chase what's been working so well at the end of 2017. Instead, I know that the bull markets are filled with rotation from one year to the next. So I want to look at some groups maybe that are off the radar that haven't been performing as well. First one, the broadcasting and entertainment group. You can see that the move up here comes off of what is pretty close to a long-term support level after it had trended lower for about 4 months. This is a group that houses Disney and some of these stocks that really struggled. But check out the volume coming in here recently on this move to the upside. I think a breakout above 1350 would bode very well for this group heading into 2018. Next, and I annotated a couple of these, but then I have some other charts I'll go over as well. Travel and tourism. This group has been pulling back, and I actually warned about this going into the last few months, probably back here near the top, because this is interesting. One of the key components here is price line. And I think one of the most interesting seasonality charts of any stock I've ever seen is probably on Priceline, where when you look at the first half of the year, it's extremely bullish. Look at these average returns by month. 5.4% in January, 8.8% in February, 7.8% in March, 13.2% in April. Those are not annualized returns. Those are average monthly gains for Priceline over the last 19 years. And then when you look at the end of the year, September minus 8.1%, October plus 1.9%, November plus 1%, and December minus 2.4%. This time of the year, this fourth quarter, actually starting even before the fourth quarter, heading into September, I think I wrote a Don't Ignore This Chart article about it back in, I don't know, probably the end of August sometime, right before that earnings report came out. But if we go back and we look at Priceline, actually, let me go back to the chart. Here you can see this is when the group took a big hit. And if I pull up Priceline, I think you'll see the same thing. Basically, the hit started in August. We took another hit in November. And this is just what Priceline does at the end of the year. But come the first 4 or 5 months of the year, we tend to, you had a huge move up in 2017, did well in 2016, 2015, the first 4 months were higher. 2014, there's a huge rally up through February, and then we kind of pulled back. And then 2013, big move. So we're heading into a great time of the year. And if I look at that chart on a weekly basis on the DJ USTT, I think we're getting close to a key support level. So a move back above the 20-day, I think would be, 20-week, I think would be very interesting. The next one, Brewers. This has been a very weak group throughout 2017, probably one of the worst performing groups. But long-term, it's still in an uptrend, and it just printed a hammer a few weeks ago right at price support. So I think this one is probably worth a shot, and especially if it can break back up above that 20-week moving average, which is where it has been struggling, and clear this trend line, this downtrend line. Many of the great performing groups that we looked at in 2017 performed the way they did after they made breakouts from downtrends or sideways consolidation. So I'd really keep a close eye on the Brewers as we head into 2018. Just a couple more. I didn't get these annotated, but two more that I really like. And I've talked about these before. One is biotechs. This is a group that tends to move extremely fast when it moves. It had a huge run up. I think the past 2 or 3 years, we have been seeing this almost like a cup and a handle. But if we clear that 2015 high, knowing how fast this group runs, I would be watching the biotechs very closely. And the last one that I had that I really want to pay attention to is in the financial space, the full line insurance group. Check out the sideways consolidation. I still see an uptrend in play, but we have really struggled over the past 2.5 years. I think a breakout in this group could bode well for 2018 as well. So these are some of the groups that I would focus on. A couple of others that I had on my list that I'll go over real quick. Let's see, had the auto parts and the automobiles. Let me pull those up, and then maybe we'll wrap it up with that. Here are the auto parts. And again, from a weekly standpoint, you can see that basically it was the end of 2017 that we made this breakout. Pulled back so far, holding the rising 20-week. But I've shown you some charts. I showed you some earlier, the groups that led. And when they finally broke out and started holding that rising 20-week moving average, those trends tended to last for quite some time. So I think this one with a fairly fresh breakout and so far performing extremely well, I could see this one continuing to go higher. And then the last one is the auto group, automobiles, which looking to make a very big breakout. We're talking about 4 or 5 years that we have been consolidating, trying to get through the 230, 235 area. We are holding the rising 20-week moving average. So I think it's starting to show some very bullish tendencies. And I think that next breakout would be very bullish for the automobile space. And so with that, I think we can wrap up the year-end 2017 review, some of our expectations for 2018, and we can move into the 10 in 10 segment.
Yes, right on time. Now we're going to really see if you can do it in 10 minutes.
All right, let's see it.
All right. Well, the first one was Square.
All right, full disclosure, I own this one. Not happy right now, but I own it. Let's see. Basically, what I was looking for and am still looking for on Square is you can see those tails. We gapped up. This is when the volume really started picking up, end of October and then really in November. But this move right here, we gapped up and we never went back down quite to test that gap support. And we also had these tails coming in on very heavy volume. So you're just imagine when you're pulling back, you're getting a lot of volume coming in at this level. So I think that this is an area of really good support for Square. I've been watching the stock for a while, and I want to see it hold this level, because if it doesn't, I mean, technically, I could see it going all the way down to where we broke out and never went back to retest. And it's kind of like Aaron was saying on some of these stocks, when you get these parabolic moves to the upside, if they don't hold support when they come back down, you want to be careful. I try to get them very close to support. If they don't bounce, I get out of them quickly. So I am watching the 34 level. For me, if it closes below 34, I'm probably going to be out of SQ. So I would watch that level pretty closely.
All right. Let's see. Number 2, HCLP.
All right, HCLP. It is, the move to the downside was pretty significant, and we've been rising ever so slowly here. It's still holding the uptrend. I would be careful if it fails to hold its trend line. And I'm just going to eyeball it, but it looked to me like it had some pretty good support right around in here. So move back down below, say 975 on a closing basis, especially if the volume were to pick up, would bother me. So that's kind of what I would watch. I'm not really keen on a stock that drops really fast and then rises really slowly. And it's just, to me, waiting maybe for another shoe to drop. So just keep a tight stop there.
Okay. Let's see. Let's go to FCX. Hold or sell this one, Tom. What would you do?
FCX. Well, I know our good friend Greg Schnell was a big fan of this one, and for good reason. Big breakout. That was a great call. I like this reversal here. It was downtrending. I love that candle. Notice we never went back down. Actually, that hammer, this is a good case study right here. Whenever I see a big breakout like this and eventually come down and test the top of that gap support on a Maribozu candle, and a Maribozu candle, by the way, is a candle where you open on the low and close on the high. And on that kind of volume, that tells me there is tremendous demand. So it went sideways for a while, but notice that hammer printed, went just below that key support and held, and then we had this big move to the upside. I wouldn't buy it here just because we're so overbought, but I love the stock, and a pullback to the rising 20-day, or as close as you can get to it, would be the best entry as far as I'm concerned.
All righty. Weed.to.
Right.
I'm wondering how that's going to end up doing those stocks with all the legalization that's happening around the states.
Well, it was a beautiful execution of an ascending triangle after an uptrend. I can tell you that much. I like the pattern. If I didn't know anything about the stock, just looking at the price action, I would say it's pretty bullish. So here was you can draw the uptrend line wherever you want, but let's just start from there. Then you can take your trend line. Actually, let's do it with the auto resistance right there. You can see multiple tops coming across here, and then the rising trend line from underneath right here. So I think we had a beautiful move up, sideways consolidation in a bullish ascending triangle pattern, and a breakout. And look at the volume on the breakout, very strong. I think this one continues to be very bullish. Another one that's moved into overbought territory. The problem with getting in here is I'm going to use the rising 20-day probably as a stop, and it's $3 below the current price. So right off the bat, a normal 20-day test, I'm going to have to give it 12% downside. That's why I always talk about reward to risk. I would much rather try to get it on a pullback, maybe to test the price support level in that rising 20-day, but I do like the chart.
All right. Next one is Stryker Corp, SYK. I don't like it. I got a PMO that turned down below its signal line. So,
yeah, I know SYK is on my strong earnings chart list. I think it's consolidating after a huge candle and a huge breakout. So I would be okay holding this one. And in fact, the closer it gets to about 151, I think would be the best reward to risk entry point. So you've got, this was the price resistance prior to the gap up on the heavy volume. And then it actually gapped up from there. So I would say 148.50 up to about 150.50 is the best support. I mean, you can see after we touched it here, actually made another run up here for resistance. I think it's continuing to consolidate and will eventually make the breakout to the upside. So closer I can get it to support, the better I like it.
Okay. Number 6, STZ, Constellation Brands.
Well, this is in that distiller group that I was talking about earlier. That's been straight up in 2017, and it may have problems holding on. You can see this one's been going straight up as well. I think it's gone up so much this year that I think it could just consolidate next year. I don't see anything horrible here on the chart. I just think that, trees don't grow to the sky, and this one has tried, put in some pretty nice branches for sure. But this one, I would just say to be careful with because it's made such a big move. Technically, I think probably the key area short term. You can see the big gap up. We get up to about 214, get up to about 214 again, keep struggling, and finally we break out with increasing volume, and 214 has been holding. So from a short-term trading perspective, I think 214 is your key support.
Okay. Number 7, Andarco Petroleum, APC. And nice breakout. I like the setup of the PMO. If I had it, I'd still be holding it.
I would absolutely agree with you. I think this one it looks great. I think the space is awesome. Energy's been on fire. Just recently broke out again, but you can see how it held after this gap up on heavy volume. Look at that tail come across. We never had a close below it, and now we're taking out the high. I think this is a very bullish breakout on APC.
All righty. It's always a point of discussion, but GE, it looks like it's found support, but I just don't, it doesn't look like it has much upside potential right now.
I don't like it. I'm just going to annotate this really quickly and show you what I think of it. I just can't get behind something like this. I mean, look at the volume. This is massive distribution. We've talked about this stock over and over, really the past month or two. I just think that this is a stock you have to wait and let them prove something. If I don't catch the exact bottom, I'm fine with that. I wouldn't care if I don't buy the stock till it's 21. I've got to see a turn in the chart. I'm going to pass.
Yeah, it's not doing too much, is it? All right, number 9. Man, you're right on there. RHT, Red Hat.
Yeah, they just reported some decent earnings, but the market, because again, so much was built into the price, it gapped down. I still like this chart, even with the big volume move. I think it is going to, in the short term, struggle with that falling 20-day moving average. If you look at the chart, it really doesn't have a whole lot of experience in 2017 dealing with the 20-day moving average being above current price. But you can see what happens here. Back in June, the stock moved down, struggled at the 20, moved down, and then finally got back up above. And that, for the most part, sent this thing on its way. So I think now that it's broken below the 20-day and on heavy volume, I would probably need to watch it pretty closely. A level maybe to keep in mind, well, definitely the recent lows. I mean, if that doesn't hold right there, then clearly the stock's got some more issues. But what I would expect maybe is that we're going to consolidate in that range right there. So I'm still bullish Red Hat, but I would not be a buyer at the current level. I'd either need to see that support around 117.50 or a move back above that 20-day moving average.
All right. And our last one is Carrizo Oil and Gas, CRZ. Nice breakout, but boy, in that energy space, I don't know if this is the best pick.
Well, I do like the breakout, and I'm probably going to say that it's not the best pick for me, but I do like the fact that it is breaking out again. I'd like to see a little bit more volume. I'd feel better about it on a bigger volume breakout. But technically, I mean, you can see here the breakout. We came back down. We tested this area beautifully, sideways consolidated here for, I don't know, 6-7 weeks, and now we're making the breakout. I just think it's a rising tide lifts all boats kind of a thing. And right now, energy is in play. And so the stock is breaking out. I think looks good, but again, I would agree with you, Aaron. I'd like to see more volume. I think there should be more volume coming into this to suggest accumulation. So maybe the rising 20-day moving average would be my stop, but CRZO looks pretty good at this point. All right, so there you have the 10 in 10, the stocks that we covered. And that is the final 10 in 10 of 2017, but we'll be back in 2018 to do some more.
Yeah, I think so.
Yeah.
I don't think we're going to get canceled over the holidays.
I hope not.
I know.
Ah, humbug.
All right. Well, with that, I'm going to move myself here to our final market update.
The final market update of 2017.
It is. It is. Everything's see you next year. Next year's candle glance. We'll see that. All right. So right now what we're seeing is the markets are just, it's interesting getting ready to go into the holiday. Usually you see, and I think you would back this, Tom, is, you usually see rising prices. So it's interesting that since yesterday afternoon, most of the major indexes have been just in a declining trend channel. The Nasdaq seems to have paused on its decline, forming, though, what I would say is a descending triangle, and that's not your best setup, as well as maybe a reverse flag. Russell 2000 looking healthier. It went down with the rest of the major indexes, but it's been consolidating sideways fairly nicely. If we get that breakout from that earlier intraday high, I would say that I wouldn't be worrying about a reverse flag here. Canada TSX is mostly unchanged, but has been trading in the negative most of the day. And we can see that as far as treasury yields, they are up slightly, still reading at 24.88. Dollar had a pretty good morning, but it's been pulling back since lunchtime, but still reading at 24.28. Commodities are having a good day despite USO struggling a bit here. Mostly unchanged at this point, reading 1164. Gold, excellent day. Gap up and a continuing rising trend channel. And it's hard to argue with that rising trend. And so GLD reading at 121.10. The VIX made a really made a quick move to a reading of 10, but we've been coming back down off of that. And as I've said, typically readings below 12, 11 are considered bullish. Most of the market is feeling bullish. All right, so declines leading advances, and let's go and very quickly look at a few of our scooter movers. And here's our top 10. Remember the two of consumer discretionary cyclicals at the top with Urban Outfitters and Michael Kors. And you can see, look at that really nice rally there on Michael Kors. It's really not, look at this. It's not really pulled back. It's not really paused. It's not really consolidated. We do see a little bit of a rough ride today, but overall, that is a beautiful rising trend channel. And, the PMO flattened out, but that's because the acceleration was pretty much steady. And this is an acceleration measurement. So you should expect it to get flat despite moving from, $53 all the way up to, 63. So very interesting to see, but it's, sitting there with that large, that high. It's the number one scooter reading right now. So kind of interesting to look at that. I think you're still pretty bullish on that sector, Tom. So anyway, I am going to conclude our final market update of the show. And of the year.
Very cool. I do want to show one other chart because this was one that I had mentioned, I don't know, maybe a couple of months ago, or no, maybe not a couple of months. Well, probably some point over the last month or two, I would guess. But it was a stock that we talked about as a momentum sleeper. And with the move higher in commodities, the stock has broken out. And I just wanted to point it out. And I do also want to say I own it, full disclosure. But MTDR. So here's the chart. And you can see on the daily chart, okay, it's a double top breakout. Volume started to pick up, good news. But when I had brought this up as a momentum sleeper, I wanted you to take a look at this sideways consolidation on a weekly chart for 4 years. And it is just now starting to make this breakout. Now, who knows? Technical analysis is only part of the game and sometimes doesn't work. But I do like this sideways consolidation and the breakout after 4 years moving sideways. We just came down and tested the rising 20-week moving average, which we have been doing successfully for the past 3 or 4 months. You can see most of this action for the last few years. You can't really count on these moving averages when you're not trending in either direction. You just simply keep going above and below. They're really not good signals during a trendless market. But the fact that it has been moving higher and holding on to the rising 20-week moving average, to me, is suggesting a potential trend. And now we're getting the price breakout potentially to confirm that. So wanted to kind of give an update on that. And with that, I know we've got our final sentiment review of 2017. What's that looking like now, Aaron?
All right, well, let's go and take a look at that. It's today was an interesting day. Now, if you recall last week, what was, I think, the most interesting of all was the exposure on NAME, the National Association of Active Investment Managers. And look at these readings down here. So last week, we saw the highest reading we've seen in how many years? 5 years. That is extremely bearish for the market typically when they're feeling that bullish. As you can see, the past couple of times, we've actually seen a bit of a pullback after we get these really high readings. So that was a bit worrisome, but apparently the market is not too worried about it. They did, what I find interesting though, is they did pull back exposure quite a bit. That could be due to, holidays and that sort of thing. But that I found very interesting. It's still a high reading because if you look back here, we've had some very low readings. So it's not like it's a complete, real bearish move on their part. I don't think. I think it is maybe associated with time of the year. But interesting to see something that large come in, and now we're seeing that pullback. So I thought that chart was especially interesting. Looking at the put call ratios, this chart that I absolutely adore. Okay, so I've marked times where we've had bottoms in these indicators, and a bottom means, since we're looking at a put call ratio, that means people are extraordinarily bullish because the number is getting smaller and smaller and smaller. That means there's far more, the call over the put. So that's why I'm looking for, these very low readings or very bullish readings, because remember, sentiment is contrarian. So when everybody is very bullish, typically that's bad for the market. Now, I can tell you, obviously, 2017, it hasn't been that much of a problem. But, calling in these right here, you can see that we did either consolidate or getting a pullback. So I find it interesting. We had these same lows, right? And you can look at it. It's a little bit, the thumbnail's kind of covering it up. But, we had these really bullish readings here. And what did we get out of it? There it is, a small pullback. So it wasn't, all that bad. But now we're seeing it did start to rise, but now it's coming back down. And even in the case here, when you look in the thumbnail for the equity put call ratios, that is now, moved lower than that previous bottom. So we're getting even more bullish as far as equities are concerned. And that should be a bit of a attention flag, I will say, that we could be looking at some consolidation and that sort of thing on its way, since everybody is looking pretty bullish. The other one I wanted to show you is the AAII investor sentiment. And this is the Association of the American Association of Individual Investors. And so this is a poll. You know, you can go to their website and you can take it. People just say I'm bullish or I'm bearish. And the readings I thought were quite interesting because we're now looking at over 50% now for bulls, and we haven't seen that all year. Even in 2 years, we haven't seen that kind of a reading as far as the bulls. Looking at that ratio, we're now hitting that 2 area, and that typically also is where you would start to look for a decline in a typical market, or some consolidation, as we've seen previously when we get these moves like this. So right now, I always look at bearish indicators, not to call a correction and not to really even call a big pullback, because that's just not the way the market's working right now. And, I don't suspect it's going to change too much next year either. So bull market all around. The last thing I wanted to show you is our exclusive RIDEX asset ratio. And for those not familiar, RIDEX has a basket of funds that are bear funds, that are bull funds, or sector funds. And then they also track their money market assets. And so by watching where the money is rotating between bulls and bear funds, it gives us some really interesting information. And again, we want to measure how bullish or how bearish the market feels, because it's contrarian. So we're looking for those money rotations. So first of all, you can notice as far as the ratio is concerned, we're looking at this is an inverted scale. So as the bull assets start to get more and more get larger, that means your number is going to start getting smaller. And so that's what we're seeing, this high amount of bullishness based on money rotation in these RIDEX funds. And you can see previously when we get to these high readings and turn, that's where we start looking for a downturn. Again, so this is since November right here, we didn't get much, but we got some consolidation off of a high RIDEX ratio. So right now we're starting to flirt with those highs again. So I'm going to watch to see when we turn down there on that ratio. But let's look at what's been happening as far as the rotation of money. We have money has been leaving the bear funds since the middle of December. And we can see money market has really stayed about the same. We're not seeing a huge, move out of them, at least currently. But overall, you can see it was mostly sideways. So it's either they've got some money out there or not out there, and it doesn't matter which fund it is. So, but at this point, the money market assets have stayed relatively flat. But look at what's happening with the bull and sector funds right now. And in the thumbnail, I think it's even more prominent. Look at this move. We're seeing since mid-December a huge move in the bull and sector funds. And even to the point we're sitting at the highest level of assets in the bull and sector funds. So the extreme bullishness is really starting to kick in. And when I look at this, that's an extremely bullish outlook that people have. They're not even hedging their bets much, right? They're pulling their money out of bear funds. The hedge is really just being in cash rather than in the market at this point. We're not seeing that move in those bear funds. And I think that's really fascinating when you see this drop in the bear funds and this rise in the bull funds like this. That's really showing us some excessive bullishness. And typically, that's a problem. So what I would say at this point, I'm going to give you a wrap up here on what these charts all mean. And I will have this in the recap as well. So what I'm looking at as far as the 10-day moving average of the put call ratio, it's at bullish extremes. Remember all those low readings on the put call ratios. And that is very bearish. When we see, anytime you see bullish extremes, that's bearish as far as sentiment is concerned. We have bullish extremes on the AAII, if you recall, more bulls right now than we've seen all year for AAII, and that would be considered very bearish. Name, they pulled back their exposure quite a bit, but I'm reading this as neutral to somewhat bearish because these guys are pretty much on it. Like they typically aren't completely wrong as far as their exposure. It's just those really climactic ones like we saw last week that should concern us. So at this point, they're pulling back exposure, which you could consider a kind of a bearish move on their part, but I see it as more of a neutral. Like I said, possibly holidays playing a part. As far as the RIDEX ratio, though, we have some real problems here with the money moving into those bull funds and out of bear funds. It's just extremely bullish. And so I would say that with this extremely bullish sentiment, it does imply that we should see a decline or in normal circumstances, a correction. But I would look more for a decline or even just a trading range, a pause. Money market funds are sitting neutral, but those monies moving out of those bear funds and into the bull funds, suggests this really high bullish sentiment. And that, of course, is very bearish for the market. But when I say bearish, let's face it, Tom, it's bearish is meant sideways or maybe a small pullback. So.
Yeah, that's like you said earlier, that's all we've seen really in 2017 is when we get to points where it looks like the market's just a little stretched and maybe needs a period of selling. We really haven't seen too many of those periods. It's been more just sideways consolidation. And I think that streak of not having a pullback of more than 3% on the S&P 500 is still in play. I think that's the case. I think this is maybe the longest period now that we've had in history as far as the S&P 500 rising without a 3% pullback. I think that was the number. I'm looking back at the chart right now and just looking at the S&P, but I don't think we've had a 3% pullback in 2017.
Yeah, that's wow. It is an impressive year, and unlike anything we really have seen. And we have to take that into account because, just because things are looking bearish or toppy, it hasn't meant pain. It just hasn't. Everybody has different positions and different things where I'm sure you've felt pain this year at times, but, in general, when you look at the market and not seeing a correction for over a year, it's pretty impressive.
Yeah, and I think 2017, if you look at a 5-year chart, I think the S&P 500, actually, I'll go ahead and just pull it up here. But if you look at a 5-year chart, what you will see is that 2017 prices have continued above that rising 20-week moving average without any problem. And if you look back to 2013, we had the exact same scenario, and it continued well into 2014. And then we finally started having some issues when we had to consolidate. But we're very overbought. Unusual to see this kind of a weekly overbought reading on the RSI. But as Arthur Hill wrote in his article, and I think Greg Morris talks about this a lot as well, overbought, I think Greg says it's kind of a useless term. I mean,
Absolutely.
if prices keep going up and you don't want to be in because prices are overbought, well, you're missing the majority of this rally, especially when you look at a weekly basis. I mean, we've been overbought now for the entire fourth quarter. And we've had a straight up move. So if your strategy is simply to get out of the market when it becomes overbought, you would have missed one of the biggest rallies of 2017 in the past 3 months. So I do think it increases the risk. And what I've always discussed and talked about is even though the S&P 500 is going straight up, not every area of the market is doing the exact same thing. We're seeing rotation back and forth. I think looking at what energy has done this week is a perfect example. Energy really was lagging for a while, and then all of a sudden this week it's exploded to the upside, and we've seen some other areas that were doing really well now have struggled. And when I showed the earlier sector performance for the year and so forth, and the industry groups for the year, not all of them were up 30 or 40%. many of them were up, and some of them, quite a bit more than 40%. But you had others that were actually red, or maybe only up 5 to 10%. So that's the beauty of a bull market, is that the money rotates back and forth, and it's really up to us to try to figure out when those trends are changing. And for me, especially as a short-term momentum trader, that's probably one of the most significant parts of analysis, is to try and find that movement as it's occurring, like with energy over the past 3 or 4 months.
Fascinating, isn't it?
It is fascinating. And we got about 10 more minutes of our last live broadcast of 2017. By the way, this has been awesome. I know, I love it. I know you love it.
Mm-hmm.
All of everybody watching loves it. We love to dig into this stuff. I'll be doing it throughout the holidays, I know, just because I don't get away from the market. I do want to just take a minute to just point everyone to the blogs and just make sure that you are aware of everything that Stock Charts has here in terms of commentary. If you go into the blog section, just click on this blogs area and you come over to the drop down menu, you're going to see a number of different blogs. Folks take a lot of time to write these articles and to approach the market, and everybody has their own trading strategies and the way they analyze the market. So I'm sure if you go through and just kind of maybe spend the holidays and check out some of the articles from everyone's blog, you'll probably find someone that you really can relate to. I know when we have Greg Schnell, for instance, on here on the show, we have a lot of folks that love hearing from Greg because his strategy is a little different from ours. His expertise is a little bit different. Living in Canada, he's got a lot of, his finger is on the pulse of energy and many of the resources, and writes about that a lot. So if that's something you're interested in, I'm sure Greg would certainly appreciate your support. He's got the Canadian Technician here that you can look at also under there. He has another blog. He's a glutton for punishment.
Right.
He's got Commodities Countdown. He's got these videos. I'm telling you, if you're into commodities, Greg puts a lot of time and effort into this. Check it out. And at the bottom of every one of these blog articles, you're going to see an area where you can subscribe. The majority of these are free, so you don't even have to be a paid member at Stock Charts. You just put your email address in here, click the notify me button, and all of a sudden you are a member of Greg's Commodities Countdown blog. And every time he posts something in this blog, it's going to be sent to your email, so you won't miss anything. I think it's a really great, sometimes overlooked feature here at Stock Charts. But I know,
of course, there's Market Watchers Live.
Of course, yes. Market Watchers Live, and Aaron does a great job recapping this for everyone. Spends an inordinate amount of time trying to recap. You can see there's a lot of great information in here every day. So if you can't get to the show, or you just want something that's more static to review, I would suggest you go here. And of course, we both would love for you to subscribe to this blog as well. So again, type your email in, click notify me.
And notice all those at the bottom, the links, because everybody's always asking, how do I get to this? How do I get to that? So my scan articles in there, Tom's blog, Decision Point, and of course, all of the indicators that we use, that's a link to the Chart School articles. So you'll be able to understand a little bit more what we're using and why we do, because you'll know how it works.
Yep, absolutely great point. A lot of good information there provided and linked for you. Let's see what else we have here before we wrap up. I know there's some questions that come in from time to time. I'll go ahead and just take a couple, and you can feel free to field a couple, maybe of your top questions asked during 2017, because I know I have a few.
Yes.
I'm going to pull up a chart here, and I'll just pull up the SPY. And you notice when I pull my charts up, I've got these 3 moving averages. I could take the 200-day moving average off. I mean, I really rarely would use it or trade off of it. By the time price action hits the 200-day moving average, I have no interest in a stock, because I momentum trade to the upside. So if it's hitting the 200-day, it's been under pressure for a while. But anyway, one of the questions I get is, why do I use a 50-day SMA and a 20-day EMA? Why would I use simple moving average on one and exponential moving average on the other? And the easy response is that I'm just weird and I'm different. But my actual reason is that I just find that it makes more sense to me personally for a short-term moving average, essentially what you're doing with an exponential moving average is you're weighting the more recent data more heavily. So if you're looking at an EMA and it's 20 days, there's more weight going into the more recent days than the days, 18, 19, 20 days ago. So it's skewing it more toward price, recent price action. So to me, my 20-day is my short-term indicator, my short-term moving average. And as a result, that's the one I want to skew. If I'm going to skew one, that's the one I want to skew toward more recent price action. Looking at a 50-day and especially a 200-day, those are long-term moving averages as far as I'm concerned. And so weighting them toward most recent data just doesn't make common sense to me. But not everybody thinks like me, so that's fine. I know that I'm probably one of the few that use both. I'd say most traders use one or the other. And I'd say probably most traders use the EMAs across the board. So I am a little weird in that respect, but it's just something I've always done. Then another question I get is why the MACD versus the PPO? Again, I have no reason to justify using the MACD. The PPO is better. I use the MACD because that's what I've always used. And I know the difference between the two. I know the big thing is that the MACD calculates the price difference between two moving averages. The PPO calculates the percentage difference between two moving averages. So the big thing you just have to remember, if you want to compare different securities by their momentum, you really want to do it by the PPO, not the MACD, because you can't look at $1,000 stock like Google and compare the MACD to Sirius XM Holdings, which is a $4 or $5 stock.
Exactly.
The difference in price obviously is going to be much different, but percentages, PPO, you can look at the two and compare them. So that's the big difference. So I don't know. Do you have one or two questions?
Yeah, actually, I'm sharing my screen right now, I think. Hopefully you can see it.
Yep.
Okay. So anyway, everybody always asks me about the PMO and how it's different from the MACD and, why it's better because I like it, which helps a lot. But yeah, the main thing I wanted to explain is that it's a rate of change ratio, so it's a momentum indicator. Go look it up in chart school if you want to see how we calculate it. But it's very similar to the MACD. If you put them over each other and below each other, you're gonna see the same thing, and you can use it. Divergences, center line, all of that. You can use that, the PMO, just like the MACD in that way. But here's the difference. The MACD is a difference between two EMAs. So the MACD is technically unbounded. So you can't really use it as an overbought, oversold indicator like you can with the PMO. And additionally, because of the way we come up with the PMO, you can actually compare PMO values across the board. So you can compare a PMO value on an index to an ETF and really be able to see whether it's stronger or less strong, similar to the scooter in a way. And the one thing you find if you use a MACD versus a PMO on like a long-term daily chart is you're going to see what looks like a tiny straight line for the MACD, and then it'll start oscillating. But the PMO is even across the board on a long-term daily chart. So that's why what the PMO is to some degree here, and why I think it is far better. And a lot of people ask me about the OBV. Why do you use the OBV? It isn't, and I'll admit, it's not quite as good as the Chaikin money flow or the accumulation distribution line. However, as I've told people, I grew up with it. I used to not type it into a spreadsheet. We would write it in, the graph paper every day. I'd go with a ruler into the Wall Street Journal. So very familiar with how the OBV works. So in my mind, I can use it better for analysis just because I know exactly what it is and how it works. So awesome. That'd be it for 2017 questions, really. I think we hit the big ones there.
Yeah, no doubt about it. We got just a little bit of time here left. Any final thoughts on 2017?
I think the main takeaway right now is the fact that, we are seeing a bull market of, proportions we've never seen. and that it has made bull market rules especially important. And I think that's what we need to consider for 2018.
No doubt about it. I think 10-year Treasury yield continues moving up. I think the small caps continue to outperform the other indices here as we try to round out 2017. I look for that to continue next week, just because historically that's what they do. So we'll continue to watch that. But yeah, I'm looking forward to a new year. Certainly looking forward to everybody joining us here. I want to just mention one more time that there will be no Market Watchers Live next week. We do have a best of Market Watchers Live that will be airing. Of course, the market is closed next Monday, Christmas, and the following Monday, New Year's, here in the U.S., so there'll be no market action. And so we're going to get some time off and looking forward to that.
Woo, yeah.
I want to thank everybody for being with us today and throughout 2017. Please remember to complete the survey as you exit. We'd love to hear from you, get your feedback, maybe an overall review of what Market Watchers Live has meant to you so far in 2017. Would love to hear those results and get that feedback. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Again, our next live show will be Tuesday, January 2nd, 2018. Have a great afternoon, everyone. And on behalf of my co-host Aaron and all the folks here at Market Watchers Live, happy trading, happy holidays, and happy New Year.